Most investors, including myself, had a great return on investments during the bull market ride from 2009 to 2022. It was a great time to invest in financial markets and real estate after the historic crash in 2008. I created most of my financial net worth through investments during this last bull market. However, most investors, including myself, experienced significant decline in the investment portfolios in 2022. And like I said, I'm not an exception. Fear of investing is still in the air at the beginning of this year. So today I'll talk about what you can do now with your money, and we'll also share with you 3 simple tips, or maybe 4, for beginner investors. Hello, 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 powerful people. Welcome to the More Money with Milan, a show that is kind of operating manual for creating your best rich life. Everybody has different version of best rich life, right? So we're talking about creating your best rich life. I'm Milan Levis, holistic financial independence mentor. I help people have more money, especially keep more money with less risk and less stress. If you want to grow your money with strategic investing, today I'm going to gift you my beginner investor toolkit that has 8 steps that you can take to become strategic investor. Okay, so here's the link, very simple link, giftfrommilan.com. Grab this download. It's very useful and very practical. And now we are ready to start our episode today. We're going to talk about what you can do with your money now. And I will share with you tips for beginner investors. So S&P 500 index, which is a benchmark, another term for benchmark is a performance measure for US listed stocks, is up 5% year to date, which is, if you ask me, pretty good considering the really poor market performance that we had last year and all the uncertainty that we are dealing with right now, from the war in Ukraine and rising military threat from Chinese Communist Party to continuous supply chain issues to high inflation, expected interest rate hikes by the Federal Reserve, and the threat of recession. So what is especially puzzling to me is that while S&P 500 index is up by about 5%, over 80% of the companies that the S&P 500 index is comprised of reported declined earnings for the last quarter of 2022. And when corporate profits decline, it's generally an indicator for stocks to go down as well, right? So there is a direct correlation between profits from the corporations and the stock price performance. So this is a reminder that stock market performance is not a reflection of the current state of economy, but rather a projected forward expected economic performance. Very important to remember. And another interesting fact is that prices of some smaller, riskier, and even less known, some of these companies even pre-revenue, they don't even have profit, they don't generate profit yet. Some of these small and riskier companies that are, I call them speculative tech stocks, have gone up. So in my opinion, it's a really strange situation, right? Really strange. And the riskier stock indices have done better than the more established, more conservative indices like S&P 500, especially since the fear of recession this year still quite high. So to answer the question that I get asked often, Milan, what should I do with my money now? Here's what I want to tell you. And this is not an advice. Obviously, I'm just sharing with you my opinion. Do not go all in into buying stocks right now, especially when it comes to riskier stocks or cryptos, okay? It's not the time to go all in with your investments. Be patient. Stay on the side of caution. Diversify your funds among cash, precious metals, and a few established dividend-paying stocks. And by the way, when I say cash, I don't mean to keep cash under your mattress, right? Because you can buy reliable securities like treasury notes, and you can buy CDs that actually right now pay fairly decent interest. Like, some of my investments that I consider cash pay over 4%. Okay. So, and what is interesting right now is that the shorter term investments, like 3-month CDs, pay high interest than long-term investments because uncertainty, and we have like inverse interest rate right now chart. So I want to share with you, after like giving you some dose of reality and inviting you to stay on the side of caution, I want to share with you some useful tips to be aware of if you fairly new to investing, because that's definitely the tips that will help you to be discerning and to assess what is the right move at the moment. Okay, so the tip number one is be mindful of market seasons. Okay, yes, stock market goes through seasons, not 4, but more than that. So, for example, usually the market goes through a rally in January, and this year was no exception, right? We had a rally in January as well. So this phenomena called January effect. Okay, January effect. Historically, stock prices have risen in January more than in any other months. Keep this in mind. It's a so-called market anomaly where stock prices go up in the first months of the year. And frankly, to a very large extent, this anomaly or this pattern is attributed to the fact that people sell all their assets in December so that they can claim capital loss if they actually had paper losses. So when they sell, they can claim capital loss for the year in order to take tax deductions, again, their profits that year, right? So it's for tax deduction purposes that people usually sell in December and then they buy in January. Now, September and October are historically the worst performing months for financial markets. Remember that. Okay, historically the worst performing months. And March and May are known for lowest returns of the year, while July, November, and December are more often than not have good performance for the stock market, with some exceptions. Like, for example, last year it was not the case. All right, so by the way, if you have any questions, make sure that you post them in the comments. I would be happy to answer them. Okay, so the tip number 2, stock market prices rise when interest rates go down, and stock market prices fall when interest rates go up. So here's the thing. The CPI, which is Consumer Price Index, measures the changes in the price level of consumer goods and services. Notice that CPI does not include food and energy, conveniently, food and energy prices, so it's not a true or accurate measure of the inflation that common people like you and me experience every day. But that's what is used by the Fed as the CPI index is used as a measure of inflation. Anyhow, the Fed uses the CPI to measure inflation and to determine whether it's necessary to increase interest rates to bring the inflation down by cooling the economy using higher cost of capital. Obviously, when our mortgages go up, less people are buying houses. When cost of goods is more expensive, so people buy less. So that's how Fed regulates the economic growth. So when the interest rates were artificially kept down for several years, right, we know that, the stock market was exploded. The low interest rates fueled the remarkable bull market that we had since 2009 until January 2022. But since the inflation level hit its highest level in 40 years, last summer it was around 9% in June 2022, the Fed had raised interest levels multiple times last year and the market reacted negatively. And since the CPI seems to be on a downtrend since June 2022 for now, right? And the Fed has been raising the interest rates aggressively for several months now. The expectation, and again, it's expectation of many financial experts, is that it's likely that the Fed will continue increasing rates. The Fed will not continue increasing rates for too long. Okay. Although nobody knows for sure what Fed's strategy is going to be this year, like they're meeting, I think, on March 21st, and nobody knows what Fed's strategy regarding the interest rate hikes is going to be. But this strategy is one of the key indicators for the financial markets performance, right? So you know that if Fed will choose to increase interest rates or hike rates over and over again, that market will have a hard time. Okay, moving on to tip number 3. Don't fight the Fed, right? It's a investor's mantra. Don't fight the Fed. Many investors and financial analysts warn us about impending recession. Amazon, and you probably heard this in the news as well, Amazon, Microsoft, Facebook, and Google announced big layoffs. I think about over 330,000 jobs were cut just by the big tech companies since January last year. So the labor market isn't really as strong as it appears to be. And dwindling labor markets, slowing economy, and gradually decreasing CPI means hopefully less incentives for the Fed to continue raising rates aggressively, okay? Hopefully for the market. So again, it's just an assumption that the Fed, which is our central bank, doesn't want to have a full-blown economic crisis on its hand. It's an assumption. So while there is still a lot of uncertainty in the markets because nobody knows for sure what the Fed will do next, right? I think they meet in, like I said, March 21st. I invite you to pay attention to the Fed's next move and to exercise extreme caution if you're going to venture into the stock market now. It doesn't mean that you have to keep all your investable funds in cash right now. I mentioned other options earlier in this episode. Instead of keeping all your investable funds in cash, what I suggest is that you start or continue contributing a fixed amount of money to your investment accounts on a regular basis. It's called dollar cost averaging. And buy more stocks when the stock market is going to be cheaper. Okay, so you will be ready with your funds. You will be ready with hopefully knowledge and awareness that it's a good time to enter, and that you will know which assets to invest in. Ultimately, the longer you stay invested in the market, the higher the probability that you will make money from investing. You know, there is this useful investor's mantra: time in the market is more important than time in the market, right? Because many people try to time the market by buying at the right time, and it's not always possible. So time in the markets is more important than timing the markets. If you follow me for a while, I'm not a fan of managed mutual funds. You can find a training video on this topic that I recorded on my YouTube channel, Milan Levy's channel Wealth. So the simplest and least expensive way to be in the investing game when you choose to play it is to invest using low-cost index funds and ETFs, exchange-traded funds, that track some market indices, like, for example, S&P 500, right? You can buy this in index funds or ETFs, and this ETFs will track indices that you want to track. My personal investment mantra is successful investing is strategic investing, which means that you've got to know the rules of the game first, right? And then have a plan to win it. Like, you would never play the game any game if you didn't know the rules, especially if you want to win it. So successful investing is a marathon, not a sprint. If you seek get rich overnight, kind of opportunity, most likely than not, you will get disappointed. And that's all I have for today's episode. Thank you very much for your kind attention and for your support of this show. I always try to talk about some hot and relevant topics to help you have more money with less stress and less risk. Again, you can download your gift today at giftfrommillion.com. It's a beginner investor toolkit.